at the heart of the system is a debt liquidity nexus. Financial markets are now debt refinancing mechanisms. They're not new capital raising systems. Now, the paradox that we've got ourselves into is that debt needs liquidity for refinancing because, spoiler alert, debt is never repaid. It's only rolled over.
Hi, I'm Ed D'Agostino from Malden Economics, and today we're going to talk about global liquidity, one of the most important concepts for an investor to understand. And thankfully, we have one of the world's top experts on liquidity to help us. Michael Howell is the author of Capital Wars on Substack, and he's a managing director at GL Indexes. And he's our guest today here at Global Macro Update. A lot going on in the world right now, particularly in the Middle East. What is the impact of war on global liquidity?
Well, the answer is hugely negative. We put a piece out on our Substack yesterday, which basically was called "The Four Horsemen of the Liquidity Apocalypse," and that basically was saying that you've got four main drivers of global liquidity. One is central bank activity. Secondly, is basically things like the collateral multiplier, which really depends on bond volatility or depends on low bond volatility. Another is the US dollar. That's another factor. And the third is oil prices. The fourth is oil prices. And you look at those four factors. I mean, we think that central banks are going to have to tighten. I mean, that is not necessarily a consensus now. But I think if you start to look within the entrails of bond markets are starting to discount higher rates. And we've got to remember that most central banks around the world don't have dual mandates. They have a single mandate, which is inflation. And inflation is likely to pick up here. The second is that oil prices have jumped significantly. They may have further to go. That's a big absorber of liquidity. The energy industry, and particularly the oil industry, uses a lot of liquidity. Just think about transit and tankers and whatever. That's very working capital intensive. Higher prices absorb liquidity. You've got the dollar, which has basically moved up by so far this month by about 3-4%. That's another factor which dents liquidity. So all these things are bad. And then as of Friday's close, we saw the MOVE index basically hitting 109, more or less. So, these things are not great omens. And basically our conclusion is that, if you look at it on paper and you extrapolate those trends forwards, you're looking at something like a 25% drop in liquidity. I mean, these are big events. And that's financial liquidity, I've got to stress.
If you're a central banker and you're looking at what's happening and this oil supply shock, are you looking at it and saying this is temporary and I should sit on my hands? Or do you in fact have to raise interest rates?
Well, I think my answer would be to that is that you've effectively got to raise interest rates. You've got to essentially put down your inflation fighting credentials. The great problem is that if you're tightening monetary conditions in this environment, you're also against you're running or swimming against the tide in debt. Debt needs to be refinanced. And one of the points that we continually make, Ed, is that, modern financial systems are not about new capital raising. They're all about refinancing existing debts. Something like 80% of all primary transactions in global financial markets now are about refinancing existing debts. And that has to be done. And if there's not enough liquidity around in the system, you get a problem. You get a financial crisis. So what we've got here is really the worst of all worlds. We've got inflation picking up. Central banks are going to have to sort of produce some sort of credibility here to maintain their inflation fighting credentials. And on top of that, they've got to make sure that debt gets refinanced. And that's not an easy task. So it's kind of damned if you do and damned if you don't. Very, very tricky.
If you could explain it in layman's terms, how does raising interest rates in this environment, how does it help their cause, right? Because there's nothing that they can do to bring oil costs down, I'm assuming.
Yeah, I think that's an absolutely fair point. And I'll show you a chart in a moment, which probably emphasizes the stress that the system could be under. But I think if we go back to the interest rate question, I mean, I think the problem that a lot of central banks have basically made for themselves is they get everybody to focus on interest rates as the main lever of monetary policy. So if interest rates go up, we're always told that slows an economy down. And if interest rates drop, that speeds an economy up. And I don't think that's the case anymore. I think a lot of, much more learned people than me have actually started to question seriously the impact of interest rates on markets. And I think you've just got to think about, the old world and the new world. In the old world, what you had is interest rates was sort of the arbiter between a private sector that was, generally speaking, borrowing, particularly through the corporate sector, and the household sector was really supplying them with funds. And higher interest rates basically, capped corporate spending and slowed the economy. And I'll come quietly on that. I mean, that's a reasonable explanation. The trouble is, it doesn't happen anymore because capital markets are no longer new capital raising mechanisms. They're all about debt refinancing. And what's more, the private sector is in a very different situation. The corporate sector doesn't have a deficit. The corporate sector has a surplus. The household sector has a surplus. And it's the government sector that has the huge deficit. So higher interest rates, what do they really mean? I mean, what they mean is that the government has a much bigger interest bill to pay, but that really comes in the form of transfer payments to the private sector. So if interest rates go up, right, what you're getting is higher transfer payments from the government to the private sector. Isn't that an income stimulus, not a contraction? So I think we've got to rethink a lot of these normal metrics. And the problem is that, we're in a world now where it's kind of looking topsy-turvy. And that's one of the problems. Therefore, the central banks have got to somehow communicate the fact that they're trying to fight inflation, but at the same time preserving enough liquidity in the system to roll over debt. And that is not an easy task. Now, just to come on to the point about, if I can, about oil, if you look at this slide, which I think kind of puts this into perspective, the problem we've got. And this is something which is maybe not a conventional indicator to watch, but it's something that I've looked at a lot over the years because it seems to be an intuitive indicator that does seem to work. And this is looking at the gold to oil ratio. Now, people in the markets do tend to look at this. Traditional economists or academics probably dismiss it as being rubbish, but in actual fact, it has a lot of truth to it. And what this shows is the relationship between an ounce of gold and a barrel of oil. And what it's arguing is that there's a long-term equilibrium here at about 20 times. Now, if you look at that chart, which goes right back to the 1970s, you kind of agree that there is some sort of convergence back to those levels. And if you look at the annotations I put on the chart, what that's saying is that, gold in 1970 was $35 an ounce. Oil was about just over $2 a barrel. So there you get your approximate 20 times. 1990, gold 400, oil 20, simple 20 times. 2015, gold $1,000, oil 50, again 20 times. 2022, $2,000 gold, $100 oil, again 20 times. So start thinking about this. And what the data shows is you get convergence back to that level within about a 2 to 3 year period, typically. So if we think about where we are now, gold is, it's dropping fast, but let's just hold the thought that it's around $5,000 an ounce or there or thereabouts. 20 times would tell you that the barrel of oil is going to $250. Okay. Now, not overnight, we'd have got to say, but that may be the equilibrium. So the question is, and I was, called by a client about a week ago when I put this out, that I was insane. This was just complete rubbish. And my answer was, look, you've got three variables here. You've got a gold price, you've got an oil price, and you've got a gold oil ratio. Now, one of those three is wrong. Okay. Either gold is wrong at $5,000 an ounce, the gold oil ratio is wrong at 20, so it must have changed in some way, or the oil price at 250 is wrong. And you've got to take your choice. And I would say, looking at what's going on in the world, gold looks pretty well underpinned. It may drop further, sure, but it's going to hang around these levels. It sure ain't going back to $2,000 an ounce, as far as I can see. The gold oil ratio has got a long-term equilibrium. I mean, that may have changed a tad, but we're just maybe splitting hairs. So the fact is that we've got a lot of inflation coming through, and oil is just representative commodities. I mean, let's talk copper, let's talk aluminum, let's talk fertilizers, let's talk food prices. I mean, these things are going up, and this is going to be a big inflationary hit for 2027. And central banks have got to do something. And that's really the problem.
How much of the gold oil ratio is impacted by the strength of the dollar? though? Because with gold, they're both. If you're pricing both in dollars, is it more an indication that the dollar is out of whack compared to other currencies?
Well, it should generally be dollar neutral, one would think.
Okay.
I mean, I would argue that the gold price, I mean, where the asymmetry is basically saying that, what should the gold price be if the dollar is under pressure? If you've got the paper dollar, I should say, if the paper dollar is under pressure, in terms of the big debt burden that the US government's taking on, therefore the dollar should devalue over the longer term. But against what? Definitely against gold. So you've got an argument to say that the gold price probably has got to go a lot higher in the long term, which is telling us here a lot about inflation pressures that are building up. And I think this is the worry that we've all got, that we've got to start to reset our parameters. And if you look at this chart, look at the annotations, I mean, someone who was around in 1970 would be familiar with oil at $2 a barrel. Somebody in 1990 would be familiar with 20. Here we are talking at over 100, and it may be a lot higher than that.
That's quite the chart. I can't stop staring at it.
Yeah.
So I think a lot of people get confused as to why gold hasn't been rallying in this environment where we've got massive inflationary pressures. The U.S. government has found yet another excuse to spend massively, blowing out deficits. Why isn't gold rallying? And I've always sort of just thought, well, it really has to do with the strength of the dollar more than anything. What are your thoughts on where gold is at price wise right now?
As we speak, gold is selling off, and it's selling off largely because it was the obvious leverage trade for a lot of CTAs. So if you look at CTA portfolios, that was the one common asset that they all had in size. And I think that, where you get volatility, you get deleveraging. And I think that's one obvious excuse or explanation as to why the gold price has come down. So this is really profit taking or simply a short-term market move. The other thing to say is that, let's think about this realistically. You've had a lot of, so far at least, a lot of potential capacity taken out in the Gulf, whether it be gas or whether it be, oil. And those Gulf states are going to have to start raising revenue. Even before this crisis, I mean, a lot of the discussion was that the Saudis don't break even until it's $100 a barrel. So, they may be getting close now, but they're not going to be shipping a lot of oil. Therefore, revenues are going to be down. They're going to need revenue. There are a lot of commitments there. Let's pause and think about the big new issues that are coming or slated to come on Wall Street in coming months. These sort of mega deals, where I think the Gulf states were likely to be big participants, but they're going to need their money elsewhere. And what are they doing? They're selling assets and they're selling gold. And I think that's another reason why you've got this profit taking.
So that's a perfect segue into what we talked about last time we got together on this podcast, which was you were indicating that liquidity was going down.
Yeah.
And that stocks, just as a blob, stocks probably weren't the place to be.
Right.
That you might want to think about selling your stocks. So has this trend just accelerated that?
Yeah. I mean, in a word, yes. Yeah. I mean, what you've had is anyway a declining liquidity cycle. I mean, let me show you some of the evidence. This is looking at global liquidity in terms of billions or trillions of dollars, I should say. This is the aggregate we calculate on a weekly basis. You can see the trend there. You can see where we've come from. You can also agree or disagree that this has been the everything bubble. So you've had a huge expansion in liquidity. I mean, going right back to the time of the GFC, you've had a doubling of global liquidity. I mean, these are not small numbers. These are big inflows of money into markets. And you can see the step ups at different times, one after the COVID crisis and then another one more recently, as a lot of liquidity is poured into markets. It looks as if that cycle is inflecting. You get a better idea if you look at the following chart, which is actually an underlying growth rate, which is sort of built up from a micro level of many different economies and many different categories of liquidity. But it gives an unambiguous picture of that global liquidity cycle. This goes right back to the 1960s. And what it says is that you've got a cycle here with a frequency of around 65 months. It seems to be almost exactly on track in terms of its inflections or its peaks and troughs, its inflections. And what we've had is a decline in liquidity beginning at the end of Q3 last year, 2025, and liquidity is basically edging down. Now, as I indicated from the previous slide, it's only just started to drop in absolute terms, but the growth rate, which is this chart here, showing a very clear slowing. And that 65-month cycle is, as we keep saying, a debt refinancing cycle that we've all got to acknowledge. And it's that debt refinancing bogey, which is really the big problem out there, aside from Iran or, troubles in the Gulf or troubles in geopolitics. The great fact is that, or the worrying fact is that we've got to refinance an awful lot of debt. And that's still out there.
There's no denying that we're closer to a problem than we have been, right? Just by default, as time marches on. You're saying some pretty ominous things, though, right? And your recent article on Substack, Capital War Substack, which is excellent, about the four horsemen. As we get closer to something, what is that something, and what does it look like? Is it another great financial crisis? Does it unfold differently because the debt is mostly in the government?
To be perfectly frank, I think it's kind of more of the same. And I think if you look at what happened in the last 15 years in financial markets, we face a repeat of that. I mean, I think it's as straightforward as that. And what does that mean? It means periodic and sharp financial crises. Those financial crises are always about refinancing problems, refinancing tensions. That causes, when there's a difficulty or an inability to roll debt, central banks are forced back into the system and they pump more liquidity in. You've got a backdrop where that means monetary inflation. Monetary inflation has grown dramatically. I mean, let me go back to my previous slide. That's global liquidity. Think of that as monetary inflation. So basically, since the GFC, you've had a doubling of the pool of liquidity. And therefore, let's say that monetary inflation has doubled. So what you've got is this continual expansion of liquidity in the system because debt needs to be refinanced. And the more that we take on debt, the bigger the problem. And, what is, with hindsight amazing is the fact that if you go back to the COVID crisis, and actually even if you just sort of go back to the GFC as well, what you find is that policymakers' responses to many of these crises have been less about injecting liquidity, although clearly they did, but much more about getting interest rates right down to near zero levels. Now, that was madness because what do lower interest rates do? They incentivize debt. And actually, on top of that, they actually encourage borrowers to term out their debt to later in the decade, as they've done. And so what you do is you basically compound and build up the problems. And that's what's happened. I mean, if you go back to the sort of doyen of central banking in the 19th century, Walter Bagehot always used to say, lend freely. We agree with that, but at a high interest rate. I mean, that's what should be done. You don't want to encourage people to take on more and more debt. And that's really been the problem. So I think this comes back to this whole idea, this whole notion of using interest rates as the main lever of monetary policy, which seems to me a serious problem. And now I think you can actually question the merits because interest rates are actually maybe ironically a source of stimulus, not a source of contraction.
Where does one hide in this type of environment? Is there a safe haven?
There is a safe haven. I think the answer is that what you do need are dedicated monetary inflation hedges. Now, those dedicated monetary inflation hedges are things like gold and silver. That's been the long-term, the long-term solution to monetary inflation. If you debase paper money systems, gold and real assets definitely do well. You've only got to look at what happened during the 1970s for evidence of that, or look at 4,000 years of history and find that gold has pretty much maintained its purchasing power. And I think that's what people need to think about quite seriously. You've also got the case that, good quality equities, those companies with pricing power tend to do well, although, in the short term, their prices may be volatile, but that's another area. And then prime residential real estate tends to be a pretty decent long-term inflation hedge. So I think these are the things that everyone needs to rethink and hold in their portfolios. So the whole idea of a 60-40 portfolio that was really been something of a luxury over the last 20 years, but it's really, it's not something that works in history. It's actually, if you look at the very long-term track record of a 60-40 portfolio, 60 equity, 40 bonds, it's been actually a pretty miserable performer. And it's only in the last 20 or so years that it's done well. But even now, it's fraying at the edges seriously. And I think what you've got to start thinking about is replacing a large part of that bond position with dedicated monetary inflation hedges, which really means, come down to it, gold. And that's one of the things to think about. Now, added to what we've spoken about are the problems in the West, the problems in Europe, the problems in the US. But, China's got big problems as well. And we've got to start recognizing that. If you start talking about debt, I mean, it's not the US and Europe that have got the monopoly here. China is big into debt. And China needs to get out of debt desperately because that's having a really deleterious effect on China's economy. It's strangling growth. Look how much growth and capital returns have fallen in China. And that's because of this huge amounts of unproductive debt. They've got to get that off their balance sheet too. They've got to create monetary inflation. And that's what they're doing. And in my reckoning, that's the main reason why the gold market has actually gone up significantly over the last 18 months. It's not been the West. It's been actually China, which has been devaluing, its paper money.
I have to interrupt to ask you for a quick favor. If you find these interviews helpful, please take a minute to sign up for my free weekly email where I give you a summary of our latest discussion, audio and video versions, along with a full transcript. There's a link in the description, so hit pause right now and take a minute to sign up. Let's get back to the interview. As we sit here talking today, a conflict is still raging in the Middle East. How does Japan factor into all of this?
I think Japan, as always, is somewhat of an anomaly here. Number one, Japan is a big energy importer, so it doesn't sit very well with higher oil prices. I think the whole argument that people put as, what is, a major risk out there, which is the yen carry trade, I kind of dismiss. I don't think it's anything like as important that people make out. It was at one stage, that is clear, but what really matters much, much more is China and understanding Chinese capital flows and where they're directed. I mean, China has the big surpluses now, not Japan. Japan can make a difference at the margin, but Japan 25 years ago was critical to the world economy and certainly world financial markets, and I don't really think it's necessarily that important today. On the other hand, Japan is facing a very different environment. Inflation is clearly picking up there and will pick up more because of higher oil prices. And it looks as if the Japanese are among the first to raise interest rates. So it may be a bellwether of where we're all going. Japan has got a big debt problem it's got to get out of as well. So, the common factor across all these economies is debt. Now, I think what's instructive to think about is this sort of whole debt liquidity nexus. And what I just want to do is to try and maybe explain that in a couple of slides. And I'm going to come back maybe to these other charts at the end. But it's really this chart which is something we need to focus on, because this is describing what the monetary system looks like today. It's not a textbook model of what the financial system is, because the textbooks are really out of date. What this is telling us is that at the heart of the system is a debt liquidity nexus. Financial markets are now debt refinancing mechanisms. They're not new capital raising systems. And what they depend upon is this debt liquidity nexus. Now, the paradox that we've got ourselves into is that debt needs liquidity for refinancing because, spoiler alert, debt is never repaid. It's only rolled over. So what you need is liquidity. In other words, you need capacity in financial sector balance sheets, in other words, liquidity, to roll your debt. Now, the paradox here is that liquidity also needs debt because liquidity is collateralized. Something like 77%, as you see in the top left-hand corner, of all global lending now is collateral-based, according to the World Bank. So in actual fact, in credit money systems, new credit relies on old debts or the integrity of old debts as collateral. And if those old debts require refinancing, they've got to have liquidity. So you see there's like a vicious circle that we've created for ourselves, that if you get any break in that circle, you get a financial crisis. And those financial crises are basically either occurring on the right-hand side of that diagram with a break in the refinancing leg, where you see term premia starting to crash and credit spreads blowing out. Maybe we're getting that now. And then you look at the left-hand side where you get spikes in the move index. Oh, look what happened on Friday. Or you get the SOFR spreads blowing out. So, what you can see here is this is beginning to fray at the edges quite badly. Now, the reason that this is important to think about is this chart, which I think I showed you before. But this is looking at the ratio between debt and liquidity over the long term for the advanced economies. And this is basically saying, look, forget about these notions of debt GDP, which are sort of, I don't know why they're calculated. They're probably an easy thing for economists to work out, but that doesn't seem to mean very much because debt GDP just seems to rise repulsively without problems or whatever. And different countries have high ratios, others have low. So what? This is looking at the ratio between debt and liquidity. And there seems to be a very clear equilibrium around 2 times. So if you get a ratio straying above that equilibrium, in other words, you go up to what looks like 220, 230 on that index on the left, you start to get financial crises because there's too much debt relative to the liquidity out there. It's very, very difficult to refinance your debt. And if you get refinancing tensions, that's the cause of financial crises. All financial crises in the last 20, 30 years have been refinancing crises. And then you look at the other side of that divide, at the bottom, when you've got a lot of liquidity relative to debt, and the vent is asset markets. There's too much liquidity. It's not necessary to refinance debt. It finds a blow-off in asset price bubbles. And that's what we're looking at. And look at those annotations. You'll see where we are. And this is the everything bubble which has come through. So that's starting to end. And it's ending really for 2 reasons. One is liquidity is going down. That's partly a natural cyclical phenomenon that's going on. But, central banks aren't helping, and they won't help if they're going to tighten. And the other reason is that if you look at this chart, it's showing the debt maturity wall. And this is basically maybe a wonkish concept, but this is basically saying, look, this is the result of COVID. This is the result of zero interest rate policies, and maybe in cases, negative interest rate policies that the central bankers basically operated through that period. And what that did was it incentivized a debt take-up, but it also encouraged a lot of borrowers, existing borrowers, to term their debt out into the latter part of the 2020s. And that debt is now coming back into the system to be refinanced. Now, on top of this, you've got in 2026, you've also got the problem of a lot of new issuance coming into the markets. You've got AI spend as well to be financed. And so there's going to be a clash between scarce liquidity, impaired even more by this Iranian conflict, and these huge demands. And that doesn't sit well. Now, what I would say is just consider what happened at the end of last year in the repo markets. And the repo markets are at the heart of the financing in a modern economy. The repo markets spiked when the Federal Reserve took out, maybe inadvertently, $200 billion from US money markets. And look at the spike you saw in repo. Now, the Fed was forced to come back with alacrity with a new QE measure called reserve management purchases. And those have actually been, pretty strong in the last few months. And that really is the problem. So here is the collateral, the SOFR spread blowout that you can see here at the end of 2025. Look at what happened. They've calmed it down, but they've calmed it down largely because they've been injecting a lot of liquidity through more treasury purchases. So this is treasuries held by the US Federal Reserve. And look at what's happened in the last few weeks. They've injected a lot more liquidity. And this is sort of sous la table because they're not broadcasting this, but this is what's going on.
Would you assume that was just sort of done in anticipation of stress in the markets due to the Middle East?
No, it was. I think Ed, rather the reverse. It was actually done as a response to the SOFR blowout that we basically got. Back here, at the end of 2025. That was a response to that problem. It's not a response to the latest one. Now, the repo markets, as we speak, seem to be relatively calm, but you've had a whopping great spike in the MOVE index, which is another negative for the system because it basically means that what you get is a lot of deleveraging forced by the fact that the collateral multiplier, in other words, how many times that you can lend on a pool of collateral, that starts to come in dramatically. It tends to drop because credit providers say they want bigger haircuts to cushion them against greater volatility. And that really is, part of the problem. Now, you can see this big move towards risk off, which is going on the whole time. And one of the other things I think that's worth spelling out, which I'm going to go to an earlier chart, which I think is this worth considering here, is this chart, which is getting into the weeds of wonkiness again. But this is looking at term premium in bond markets. Now, as I've read the media in the last week or so about this bond market sell-off and how bonds are crashing and everything else, whatever, I would say actually it's the opposite, isn't it? If you look inside the bond markets, what you can see is actually the reverse happening. You're seeing term premium in the bond markets starting to drop away significantly. Now, this is not what the narrative should be telling us, or it is telling us. The narrative is saying there's no demand for bonds. Falling term premia is actually telling you there's increasing demand for bonds. The problem in the bond markets is not the fact that there's change in demand. There's actually, the problem is that rate expectations are going up. So what this chart here is trying to show is that big divergence in the bond markets. Now, if you take that orange line, the term premia line, term premia are the extra compensation that investors demand to hold a bond. So if that term premium is dropping, investors are saying they want less cushion. They're prepared to accept a lower yield, basically just to hold bonds. So that big plunge that you've seen from basically mid-February to date, this is daily data, is telling us that the demand for bonds is increasing significantly among major investors. And the reason that you've got bond yields going up across the curve is that that black line is telling us that terminal policy rate expectations, in other words, what the bond investors think central banks are going to do, is they're going to raise rates. And that seems to be increasingly baked in. And I would suggest that's probably correct, because to maintain inflation credibility, central banks are going to have to push rates up. Now, that is the dilemma that everyone faces here, because that's going to strangle liquidity, other things being equal.
So large investors, institutional investors, governments are saying, we want more bonds. We want your bonds, but we want a higher rate. Like that's like a little bit of a brain twist.
Well, what it's saying is that the front end of the curve, they're saying that rates are going up. But in actual fact, what the orange line, the term premium, is saying is actually that's indicating, take that as a signal of increasing demand for bonds. So what you're getting is you're getting the yield curve flattening. And that's really a really important point, because it is consistent with this whole story. And I just want to show you this chart because maybe it's an important one, but it will tell you what's going on. This is looking at term premia. So this is the extra compensation that bond investors demand to hold a bond, shown in black, okay? And that's actually the change on a year ago, but whatever, just take it as a term premium measure. And the orange line is our global liquidity index. Now, what that's saying is these two data series are completely different. One is the flow of liquidity and the other is a rate that comes from the bond markets. And what you can see is they line up exactly. So what the story here is that as global liquidity retreats, so the demand for safety in the system starts to increase dramatically. And that's what we've got going on right now. So there's a great shift here into safe assets. And I think it's it's not being recognized by a lot of commentators, particularly in the media. They're not acknowledging this. They're saying, avoid bonds or whatever. But the message here is that you want safety. We're not going to say go into very long duration yet, but certainly you want to be going into the front end of the curve, raising cash, I think, in this environment. And I think that you've just got to treat this whole exercise of the Gulf, whether the tensions are over tomorrow, I mean, who knows? But I think the damage has been done. And, oil is not going to come back quickly. Inflation is going to be an embedded problem. Liquidity is going to be scarcer than it was, and economic activity is going to be impaired. And I think, therefore, you need to have some degree of safety. Is this bull market over? I think it probably is. That's my contention. I think we need to go risk off.
When you say something like the bull market is over and we should go risk off, in general, what's the timeline that you tend to operate on? Because some investors will say, well, you'll have an interview with an investor and then you find out where their timeline is, say, 6 months. Others will say it's 6 to 18 months. How does your research time out, if you will?
Well, what we come back to is this global liquidity cycle. That basically is the tempo of investment for us. And that is a timeline of the average cycle. So the black line is looking at the average liquidity cycle since 1970 in terms of months. So minus 30 is when it starts, minus 30 months. 0 is the low point. Plus 35 is on the right, is when it ends. And the current cycle is in red. So the current cycle doesn't look, dramatically different from what a normal cycle looks like. Now, we tend to put that into a framework, which is shown here, which is looking at how the investment cycle works. Now, the way that we read this is to say the upswings of the cycle are when you want equities, you want to be risk on. The peak of the cycle, you want commodities. I mean, we're at the peak, commodities have been doing well, etc. In the downswing, which I would argue we're getting close to, if not already there, you want more cash. And then you want bonds, longer duration bonds around the trough. And then the cycle restarts. So that's really looking at a cycle which, let's say each particular phase, so we think of calm, speculation, turbulence, rebound, maybe about 15 months each phase. Now, if you look at these traffic lights, which basically inform through each of the regimes, and let's say that this asset allocation began in late 2022 with the rebound phase when liquidity started to shoot up significantly. That was when you wanted, you read this, by the way, just like a traffic signal. So green is go, red is stop, amber is proceed forward with caution. What that's saying is in the rebound phase, late 22, you wanted to be increasingly risk on, not fully risk on, but cautiously moving that way. You wanted to be full on equities, full on credits, no commodities, no bond duration. By calm, which was basically by middle of 2023, you wanted then much more risk on, more leverage, more equities, starting to trim credits into commodities, and no bonds yet. Speculation where the US market has probably been for a few months now, maybe 6 months or so on our reckoning. That would suggest that what you should be doing, actually maybe a tad more than 6 months, I should correct myself. But through much of last year and whatever, you wanted to be beginning to pare down equities, no credits, strong on commodities, beginning to put a toe in the water in terms of bonds. Turbulence, which we're not there yet. We still think the US is still late years in the speculation phase. Turbulence, you basically want no equities or very low equities. You want to be maybe thinking about credits because they may have come back because of a year of more carry. Commodities starting to get out of, bond duration full on. And then you look at industry groups, the same sort of message. Technology does fantastically in the first two phases of the upswing, but you don't want them in the speculation and turbulence phase. Financials do really well in calm, but you want to be out getting out in the speculation now, and that's probably not a bad call. Energy commodities you can still hold. Energy, still looks a decent play, I think. And then you want to be increasingly thinking about defensive areas. But what I'm saying here is maybe this chart does that. Is to say, think of this in terms of an asset allocation cycle, and you can see the time frames. This is saying this is the percentage of markets in the risk-on categories of rebound or calm. Now, at the moment, worldwide, we're just on the cusp of going below average, but you can see those cycles, how they unfold. And, I wouldn't want to be messing in markets too much in the next 12 months. Hopefully I'm proved wrong, and it's a benign environment. But I just think you've got to pay attention to liquidity. And as far as I can see, liquidity is basically being drained. And the competing demands for liquidity in terms of debt refinancing are just, skyrocketing.
What did I not ask you that I should have?
The last point to maybe make on this is China. And if you look at China, what chart is illustrating is the differential, or maybe we ought to say the growing differential between the US and China. The black line here is looking at US liquidity. Okay. And you can see that cycle has peaked and has come down. Maybe there's a little notch up in the last month, but hey, forget that. It's clearly come down. China, the orange line, used to be really in step with the US, particularly around 2000 and when it got into WTO. So it was, moving with the US cycle, or at least trying to. Then you saw this long period through the post GFC crisis period where China was struggling to, get out of its bubble economy, its overinvestment and whatever else. And monetary conditions were kept pretty tight. And now what you see is China relaunching a monetary cycle that is basically acyclical or anti-cyclical with the US. And you can see there that China is just completely different from what the picture in the US is. So China is easing now that the US is tightening. And I think that is material because it should suggest that the Chinese markets actually hold up a lot better, and they have been, than Western financial markets. Now, the reason that is going on, I'm going to spin to much later on in the presentation, is because of this chart, which is looking at the debt liquidity ratios of China and Japan. Now, you recall maybe from an earlier slide what the debt liquidity ratio for the advanced economies was, which was basically Europe and America. And that was, seeing the beginnings of a sharp downward V pattern being or unfolding. China and Japan are in a very different situation, and they've had very elevated debt liquidity ratios for a long time, and that has caused their economies or strangled their economies. Growth has clearly come down in Japan dramatically from what it was in the 80s. In China, it's also slumped, and they need to get out of debt. And the only way you get out of debt in a modern financial system, because you can't default debt because it's the collateral for the system, is you've got to devalue it. You've got to devalue your paper money. So what has Japan done? Abenomics was all about basically reform and getting the BOJ to buy huge amounts of JGBs, in other words, monetizing. What happened to the yen? It's collapsed, right? What is China doing? China's doing exactly the same thing 15 years later. It is monetizing its debt domestically. It's trying to hold up the external value of the yuan because it's basically, I say fiddling the system, but it's doing what Japan did in the 80s because they've got such a big current account surplus that they can basically control capital flows, and they've got controls on capital anyway to make it even easier for them. So they can fix the external value of the yuan, but internally it's devaluing, and they're printing money as if it's going out of fashion. So this is net liquidity injections by the PBOC, and there's, this is the year-on-year change, not the actual level. So you can see what they're doing here. There's an accelerating injection of liquidity. And what that means is that the yuan gold price, this is a bit out of date because it's since obviously come down in the last few days, but this is the yuan gold price. And this is what we think China is targeting. Don't look at COMEX anymore. Don't look at the London Gold Exchange. The marginal pricer of gold is the Shanghai Exchange. It's Asia which drives gold and silver prices now. And this is the mechanism. They are monetizing their debt away. And internally, China is basically printing money and the yuan gold price is going up. And here is the evidence which shows the gold price in US dollars. Again, this is end month data, so it hasn't got the latest drop in, but that is PBOC liquidity against gold.
Oh,
and
interesting.
In my view, it's the Chinese that are doing this, not the West.
Amazing chart. Wow.
So that's the other story. You got to keep thinking about gold long term. This is the buy it on pullbacks.
In terms of timing, again, is your belief that China is just going to continue with this policy, that they're nowhere near stopping yet?
Yeah, they are. And they put $1 trillion US into their markets last year. They're going to have to do the same again, in my view. They need to get that economy moving. And that's even more paramount in a communist system like China than it is in the West. They need to basically keep people's incomes up, prosperity rolling on. Otherwise, there's a lot more questions being asked. So I think that's the priority. And like core holdings, I mean, the question is, don't trade gold, own it. That's the bottom line.
Yeah. I couldn't agree with you more on that one. And I know you were going to be at our strategic investment conference for a much deeper dive into your presentations. I'm really looking forward to
me
that.
too. Looking forward to that, Ed. Thanks a lot for your time.